You hear it all the time on the financial news, right? The market is up today, or the index just hit a brand new high. But what exactly does that mean under the hood? Well, in this explainer, we're popping that hood to look at the ultimate barometer of India's economic strength, the Nifty 50. We're going to see exactly what it is, how the mechanics work behind the scenes, and why it's an absolutely foundational tool if you're looking to build long-term wealth in the Indian equity market. Let's get into it.
So, here's a pretty fascinating question. What if I told you that you could own a piece of the absolute largest, most successful companies in India with literally just a single trade? Look, for a lot of investors, the idea of picking individual winning stocks is, well, it's completely overwhelming. It's risky, it takes a massive amount of research, and let's be honest, even the pros get it wrong all the time. But the Nifty 50, it offers this brilliant low-cost solution. By tracking this one single index, you aren't just betting on a single company. You're essentially betting on the collective growth of the entire Indian economy.
Okay, here's our quick roadmap for today. First, we'll officially meet the Nifty 50. Then, we'll break down the free float methodology. After that, we'll look at the sector and stock heavyweights. And finally, number 4, how to invest smartly.
Section 1. Meet the Nifty 50.
Launched back in 1996, the Nifty 50 is a benchmark stock market index. It basically tracks the performance of the 50 largest, most well-established blue-chip companies listed on the National Stock Exchange of India, or the NSE. So, you know when people casually talk about the market in India? They are almost always talking about the Nifty 50. It's the premier benchmark that investors, analysts, and fund managers literally all over the globe use to gauge how Indian businesses are performing on any given day.
Think of it like a diverse, high-definition snapshot of the country's financial health. It doesn't just focus on one single industry. It spans 13 key sectors of the economy. And these are highly liquid companies, which just means their shares are bought and sold in massive volumes every single day. By tracking these 50 titans across all these different industries, you're tracking the resilience and the momentum of the broader Indian economy. Put simply, if these companies are growing, India is growing. And to put this massive scale into perspective, just these 50 companies alone capture roughly 65% of the National Stock Exchange's entire float-adjusted market capitalization. 65%. There are literally thousands of companies listed on the exchange, right? But this one elite group of 50 does the heavy lifting, making up nearly 2/3 of the market's tradable value. It's an absolutely incredible concentration of economic power. Moving right along to Section 2, the free float methodology. Now, here's a fascinating twist in the math. Usually, a company's total market cap is the value of all its shares combined, right? But the Nifty 50, actually, scratch that. It completely ignores that total number. Instead, it uses what's called the free float market cap. This means it only counts the shares that are actually available for public trading. It strips out all those shares locked in by promoters, founders, or the government. And this is a super crucial distinction because it ensures the index reflects true market realities and actual liquidity, rather than just the paper valuations of a bunch of locked-up shares. To give all this math a solid starting point, the index's base value was anchored at exactly 1,000 points using November 3rd, 1995 as the base year. So when you look at the Nifty 50 trading at tens of thousands of points today, you're looking directly at the compounding growth of India's top publicly tradable companies since that initial baseline back in the mid-90s. Pretty amazing to see that growth visualized like that, isn't it? The actual math behind the scenes happens in 3 really simple steps. First up, the NSE determines the number of publicly tradable shares. Second, they multiply that by the share price to get the company's free float market cap. And finally, they divide that specific company's value by the total free float value of all 50 companies combined to get its percentage weight. This step-by-step calculation guarantees that the companies with the absolute largest public market value have the strongest influence on the index's daily movements. All right, on to Section 3, sector and stock heavyweights. So while the Nifty 50 does represent 13 sectors, I've got to tell you, it is definitely not an equal playing field. Financial services acts as the biggest component by far. It controls over a third, around 35 to 37% of the entire index. We're talking major banks and insurance firms here. Following that, you've got IT, oil and gas, and fast-moving consumer goods. What does this mean for you? Well, if there's a major policy change affecting banks in India, the entire Nifty 50 is going to feel it immediately because of this massive sector concentration. And when we zoom in on individual companies, the concentration is just as staggering. Remember that free float calculation we just talked about? Well, it results in heavyweights like HDFC Bank holding around an 11% weight, ICICI Bank right around 9%, and Reliance Industries sitting near 8%. Now, these numbers naturally fluctuate daily, but the reality is that these specific titans significantly drive the daily market trends all by themselves. Basically, a strong day for HDFC and Reliance usually means a really strong day for the whole index.
Which brings us to this absolutely crucial takeaway. The top 10 stocks out of the 50 make up roughly 54% of the entire Nifty 50 index. Think about that. More than half of the weight is concentrated in just 10 companies. That means when you track the Nifty 50, a handful of massive, highly liquid titans are doing the vast majority of the heavy lifting for the entire Indian stock market. Understanding this dynamic is essential if you want to know why the index moves the way it does on any given day.
Let's wrap things up with Section 4, How to Invest Smartly.
So, there are a few ways to actually invest in the Nifty 50. The first is direct equity, literally going out and buying shares of all 50 companies individually. But let's be real here. To replicate the index weightings accurately, that requires massive capital and constant, tedious manual rebalancing every single time the weights change. It's a headache. Thankfully, there are much smarter, passive ways to participate that don't require you to be glued to your screen all day: index mutual funds and exchange-traded funds, or ETFs.
Let's quickly compare those two easier routes. Index funds mirror the 50 stocks automatically. They're absolutely brilliant for passive investors because you don't even need a demat account, they auto-reinvest your dividends, and they're tailor-made for setting up a systematic investment plan, or SIP, where you just invest a fixed amount every month on autopilot. ETFs, on the other hand, do require a registered demat account, which is just a digital account to hold your securities, because they trade live on the stock exchange exactly like regular shares. ETFs give you real-time pricing and ultra-low expense ratios. Honestly, both options are low-cost, incredibly efficient ways to get direct exposure to India's top companies.
There's this quote from the source material that perfectly sums up the whole strategy. Investing in Nifty 50 provides the benefits of diversification within the largest companies in India and returns in line with the economic growth. You aren't trying to find a needle in a haystack. You're literally just buying the whole haystack. It's a foundational strategy that completely takes the guesswork out of investing, letting you just ride the wave of India's broader economic expansion over the long haul.
So, we've covered the mechanics, the heavyweights, and the smart investment strategies. Whether it's setting up an SIP and an index fund today or just starting to research an ETF, the tools are right there at your fingertips. I'll leave you with this one question to think about. Now that you know just 50 companies drive the vast majority of India's market growth, are you going to keep trying to guess the next single winner, or will you just buy the whole engine? Thanks so much for joining this explainer. Keep exploring, and I'll catch you in the next one.